I mean, are you still finding opportunities out there, or have they been picked over pretty good?
Yeah, we still find some compelling opportunities. It's not right across the board, but we like seniors housing in Canada and the United States. We like grocery anchored shopping centers. We like industrial. We still see the secular fundamentals driving demand there. We've moved down weight in the United States. We increased our weight in Canada and Europe. And we like select sectors in the residential area. And we still find some compelling opportunities based on an assessment of supply and demand matching with valuations.
Well, good morning, folks. It's Victor Adair, and I'm sitting here. I've got Jeff Olin on the line from Toronto Vision Capital. And Jeff, of course, well known to the Money Talks audience here over the last 10 years. And Jeff, I think you've been out to the World Outlook Conference in Vancouver 5 times. The last time you were on the show with Michael Campbell in April of this year, you gave him a handful of names of different things that you liked in the real estate sector. I see, and this is just a great intro, that all of those 5 things have gone up at an average of about 20% across the board. And that's just over that period of time. If you annualize that, it's almost a 50% return. Wow, what a call. Good for you.
Sure.
Okay, Jeff, we're here today to talk about what you do in the real estate space. And when I've listened to you for so many years at the World Outlook and on the show as well. And in my heart, I think Jeff is a old school value investor. Like, he really crunches all the numbers and finds things that are undervalued or overvalued, and then makes an investment, not by going out and buying a building or something like that, but by using, let's call it publicly traded stocks mostly, but also debt, to take a position in the real estate space. You're like an arbitrageur who's making the bid, the spread between the bid and the offer. So tell us a bit about how you run the business, and then we'll get into the different products that you have and some of your picks that you have for us on this week's show.
Thanks very much, Victor, and thanks for having me, and best to Michael. So our process is a combination of a top-down and bottom-up approach. So it starts top-down, supply and demand fundamentals, which we call our blood, by property type, by geographic region, employment growth, macro conditions, regional economic trends, tax, regulatory changes, to identify those property sectors that we think have favorable fundamentals. And then it's a rigorous bottom-up process to consider management teams, lease structure, corporate governance, balance sheets, alignment of interest, to establish our view of the underlying net asset value of the real estate. What is that real estate worth in the property market? And then compare it to what it is trading at in the stock market. And our goal is to buy real estate cheaper in the stock market than one can in the property market. And if the fundamentals are poor or deteriorating, or valuations are just too high, well, you can't do anything about that in the property market. We can do something about it in the stock market by going short.
Okay, so that sounds like the old-fashioned classic hedge fund. When hedge funds were first started, they would take like a group of stocks, let's say the airline business. They would buy the best in that group, sell the worst in that group, and then if the overall stock market went up or down, they were kind of impervious to that. They were just making the difference between those two markets.
I think that's fair, except there's one significant difference between real estate and any other asset class. And that is the private market for real estate properties dwarfs the size of the public market for real estate securities. And there is an arbitrage between the two. So when you have undervalued securities, one of the cheapest, one of the most effective ways to buy property, which folks like Brookfield and Blackstone and others government of Singapore, which bought Summit REIT in 2022, have figured out, is to buy the entity, because you're buying high quality properties and at times platforms to enter into a market or an industry sector cheaper than you can by going out and buying the properties one by one themselves.
Okay. Now you talk about it, I should say, like on your website, it's an alternative investment that you are doing. And I mean, this is worth drilling into a little bit. I mean, we have the classic investments where people are going to buy stocks and bonds in different ratios and that sort of thing. But an alternative investment typically will perform differently than say, the classic style of investment. Do you see your alternative, your vision funds almost as an opportunity for people to balance out their traditional portfolios if they're to invest in the vision funds?
Exactly. I mean, well, our absolute returns have been great over 16 years. I think one of the leading global banks that were on their platform said you guys have delivered twice the return of the index with half the volatility. So the absolute returns are great, but they're about 10.5% CAGRs, 16 years. But we don't strive to be the best performing fund in North America. We would like to be, to the heart of your question, the best risk adjusted performing fund. And so when you look at the fact, for example, 4 of the prior 10 years, the REIT index was negative, or the broad market was negative, or both, and we generated positive returns. So, our goal is certainly to have compelling risk adjusted returns using our approach. And most of our short positions are not sort of wild bets. They're part of long, short, paired trades, exactly in the manner you described in the airline industry. Mm-hmm. So we'll go, and so in doing that, you reduce risk where both can go up in price or both could go down in price, and we can make money because the spread relatively between the two narrows.
Okay, when you say we can make money, you started your original fund, I think it was back in 2008, but at that time, and ever since then for that product, that has been for institutional accounts, high net worth investors, and so on. You started in 2019, the Vision Alternative Income Fund, and that is something that people like me and other retail investors can get into. We can buy it, we can put it into an RSP. Is there a difference between the two funds, or are they pretty much the same thing? It's just structured different?
No, we were an early adopter of regulators in this country said they wanted to democratize access to individual investors to get some of the same risk-adjusted returns that institutions receive. And the answer to your question is no, it's identical. The Vision Alternative Income Fund has the same holdings, it has the same fees, it has the same liquidity as our long-standing limited partnerships. So yeah, you can get exposure through your RSP in the manner you described through the Vision Alternative Income Fund, which is available in every bank platform and independent dealers in Canada.
Jeff, before we maybe get into your, let's say, your current themes and some of your favorite picks right now, I'd like to talk about just, I know you already went into this a bit, the process, but when you get an idea that you want to look at something, and then you do your homework and you take a position, let's say in this case, you go out and buy something, a security that you think is undervalued relative to what it should be because of the homework you've done. Now, maybe, the day after you bought the thing, the price of it goes down, or the week after, or the month after. I kind of would assume that a value investor, you've done your homework, it's sort of like, you're right. So you're going to stay with this position until sort of the world comes around to agreeing with you. How do you manage your risk on that sort of a situation?
Well, firstly, this is real estate, and we're longer term investors. I mean, mm-hmm. We might have liquidity in a day, but the themes we focus on, driven, as I mentioned earlier, driven by supply and demand, are typically longer term themes, and we'll have our core holdings for years. Typically, we'll trade around them. So if something changes, new regulation, management, Yeah, we might change, but typically, we will stick to the investment as long as the framework that, gave rise to us making that investment hasn't changed. That being said, we don't like to buy undervalued securities and hope they go up. You can have value traps, and we've seen it in our space for 80, 90 years. So we seek to be active investors. We don't seek to be hostile. It takes you 30 years to build a relationship. You can lose it in one day. But we're very active on our names. We're very engaged with management teams. And as a result of this, the Vision funds have benefited from 21 takeovers in our portfolio holdings in the last 16 years because of that arbitrage opportunity we talked about earlier.
Some of the homework that you're going to do when you make a decision to get into the market one way or the other, let me call it, it's going to be macro. You're going to take a look at how the world is. Now, right now, it seems the whole world, with the exception of Japan, is in an environment where interest rates are being cut. And I would think that would, all of the things left aside, that would be good news for the real estate market. Am I right or am I wrong? Or is the interest rate decline around the world a significant macro investment for you and your team?
It's certainly a factor. We've demonstrated for years that supply and demand trumps interest rates, but interest rates are a factor. And to your point, historically, when you've seen, we don't know if the Fed's going to cut twice or three times, 24, 25, but Fed's not going to increase rates. And historically, when you see Fed tightening peak, the following 12 months, the REIT index was up 20.9%. And so, people have asked us over the last 16 years, is this a good time to invest with Vision? And not that we want to avoid answering the question, but we explain we're a long, short fund. We seek to outperform through all market cycles, which we have. We're answering the question differently now precisely because of the point you raise. You combine the fact that interest rates appear peaked in the short to medium term, and then you consider that investors are the biggest underweight to REITs they've been since the global financial crisis. That is a really bullish indicator for our sector. Any sort of reversion to the mean would be positive to the sector. We were at the Bank of America Real Estate Conference in New York 2 weeks ago, and their data as of the end of August is 28% of investors are significantly underweight REITs. And so that flow of funds should be salutary to the answer to your question, that the timing looks pretty interesting.
Well, I'm going to guess that those investors may be underweight in REITs and overweight in big cap tech. I can see you smiling there. How about this? The benefits that are going to come with lower interest rates. You were saying about REITs being under investors being underweight in REITs. We go back to, say, October of last year. Weren't the REITs themselves really let's say the assets that they had were undervalued within the REITs?
Oh, that's for certain. Again, you have to bifurcate it by property type and geographic region. But certainly on average, the REITs were trading at a material discount to the underlying value of the real estate that they owned.
Okay, that's what I meant to say. I got a little tongue-tied there. So I'm assuming then, since last October, when, let's say in October of 2023, we had the long bond in the United States was trading at a 10-year high yield for about 5% on the 10-year. That's come down considerably since then. So we've had, I'm assuming then, a run-up in the value of a lot of the REITs. And I mean, are you still finding opportunities out there, or have they been picked over pretty good?
Yeah, we still find some compelling opportunities. It's not right across the board, but we like seniors housing in Canada and the United States. We like grocery anchored shopping centers. We like industrial. We still see the secular fundamentals driving demand there. We've moved down weight in the United States. We increased our weight in Canada and Europe. And we like select sectors in the residential area. And we still find some compelling opportunities based on an assessment of supply and demand. matching with valuations.
Okay, now I'm assuming those are buys, that sector.
Sure.
And is there anything you don't like or anything you think is overvalued and it's worth being short in terms of a sector, not individual names?
Yeah, we're still net short office. I mean, we are now more constructive and on. We're long New York City office, and we're short West Coast US and Canadian office. We're short self-storage in the United States, and we're short hotels. Those would be the three. And we're short nursing homes in the United States as well. Some significant labor pressures in that space. So yeah, we still have a balanced approach. That hasn't changed.
Okay, before we drill down, maybe get a name or two in some of those areas that you like, I have to ask you this sort of the $64 million question, and that was all the doom and gloom that came out about the looming refinancing wall that was going to hit the commercial real estate sector and how it was going to be worse than the 2008 financial crisis and all. I mean, every day I'm exposed to this really doom and gloom stuff. Often, as I say to my friends, from people who have no idea what they're talking about. But sometimes there are some pretty savvy people, and it makes you think. So you're an expert in the real estate space. I'm sure you know what I'm talking about. What's your take?
There has been, there is, and there will be distress in select commercial real estate sectors, for sure. You've seen the Blackstone hang back the keys to lenders in LA, and Brookfield hang back the keys to lenders in office buildings in LA and Washington. There will not be any distress in REITs because of balance sheets. If you're a private equity fund or an individual, you're likely using 65% leverage, borrowing 65% of the value of the real estate. The REIT sector in the United States today is 34% leverage, 4.9 times interest coverage ratios, 91% fixed rate debt, with a weighted average term of 6 years. Balance sheets are the best they've ever been. And then you add the fact that if you're a pension fund or a private equity fund or an individual and you want to put debt on your real estate, you're getting a mortgage. 85% of the REIT sector in the United States is investment grade rated. They're using unsecured bonds. And the cost of unsecured bonds has recently been as much as 150 basis points lower than secured mortgage debt. So what you're finding is REITs are starting to take advantage of some of the distress by using their balance sheets to do accretive acquisitions similar to what we saw for over a decade back in 2020 and before. So yeah, it's an insightful comment, but REITs are in pretty good shape.
Super, and I love your answer. Thank you very much. Hey, let's drill down a little bit. Let's start, say, with senior housing. You mentioned that's one of the things on your radar. You like it. I'm assuming that you're invested in some already, and maybe you're looking to find some others. You want to give us a pick in that sector?
Sure. There's a number of holdings. I'd highlight two quickly. Chartwell Retirement Residence REIT, CSH, on the TSX. It's about a $4 billion market cap. They're significantly increasing their occupancy. It has a nice 4% yield. We like Sienna Senior Living, TSX, symbol is SIA. It's got a 5.5% yield. We think it's worth around 19, trading around low $17. So those would be two good names for your audience.
When you look at something like both of those, let's say they're both yielding around 5%, do you see it as mostly a yield play with a little, maybe top up, a little gravy, as it were, that would come if the asset values rise themselves?
No. Those investors that buy REITs for yield, in fact, those investors that buy anything for yield, in our view, are really misguided. Don't ever buy anything for yield. And the income trust debacle in Canada is a case in point. I mean, remember Yellow Pages? They were a dodo bird at the time of their IPO. And, Canadian banks would package these things up with yield and say, this has got an 8, this has got a 7, 8's higher than 7, buy this one. And they were using their own money, investors' money, to pay them back yield. So yield is good, but it's part of a total return. Those investors that buy REITs for yield, there's at least 1 month every year you typically have a capital loss that destroys your yield for the year. So yield is nice, but for us, it's net asset value, and yield is just part of it.
Jeff, I just love hearing you say that because I'm a commodities trader, as you probably know, and I see people that will buy some of the famous names that we have in Canada, in let's say in the banking space and or pipelines or whatever for the yield. And I think, holy mackerel, I could just look on the chart and I can find a half a dozen days in the last year where the value of the stock has dropped more than what the annual yield is going to be. But anyway, thank you for shedding some light on that. Let's go to the industrial sector. When I look at the sheet I have here, I see you see some opportunities not only in Canada but also in the UK.
Yeah, we think the supply and demand, forget what I say. We're at Prologis, one of the finest companies in any sector, the largest player globally in industrial logistics, and they cite Toronto as the best industrial market for them in the world. So we like Canadian name, Dream Industrial REIT, DIR on the TSX, trading below 15. We think it's worth close to 19. So, a 23% discount to value. It's got a nice yield, 4.8%, and a market cap of over $4 billion. And they're positioned in Canada, about 70% of their value, and Europe, and in Netherlands and Germany. And so we think they're really well positioned. They're smaller bay, so they're not as exposed to some of the new supply, that big box supply that they're seeing a fair bit of supply. And we like, to your comment, in Europe, we like Segro, which is a large enterprise. It's about $12 billion, or 12 million pounds, I should say. And we also like another European name called Tritax Big Box, which is trading at a 22% discount to our value of the real estate. Those are also great names with exposure in Europe.
Okay, now here's one that's it just kind of leaps off the page. Data centers. I mean, if data centers haven't been in the news, I don't know what's been. I mean, was it last week? Microsoft is going to restart one of the nuclear reactors on 3 Mile Island exclusively to power their data center. But you like data centers? Tell me.
Yeah, so this is a sector we shied away from for a decade because, well, the external growth was prolific, demand was strong. It was being met with new supply. Until about 2 years ago, because everybody around data centers recognizes what you just summarized, that the key gating factor for a data center is access to a lot of reliable, redundant power. Well, municipalities figured it out a couple of years ago. It was putting strains on the power grid, and they started putting moratoriums on development of new data centers. And so, well, that rack space for Google, Amazon, and Facebook, when it renewed, you were getting lower rents. 2 years ago, that shifted. Now you're getting materially higher rents, organic internal growth to complement the external growth. This is really early stages. We like Digital Realty Trust, which is one of the big players in the space. We think that has a long, long way to go in terms of upside. And so that would be a great name for your audience. It's a $54 billion market cap, New York Stock Exchange listed REIT.
Holy mackerel. I mean, is that a big number? I just don't know.
It's a big number.
Okay. I should say residential, and I'm gonna think within that you've got manufactured housing and multifamily. But just stop a second here. When I saw manufactured housing, I thought, oh, you mean trailers? Okay, and then I read about what that is, and trailers are like, no, Victor, it's way more sophisticated than that.
Well, you're not far off. I mean, that's one of the reasons this is so attractive. Is it's a really misunderstood sector. I mean, you look at some of these manufactured housing communities, and you can't tell the difference between the single-family residential subdivision and a manufactured housing community. The fact is, these are prefabricated manufactured homes and put on these REITs land, and the buyers of the homes pay them land rent. So it is, and they have some trailer parks and RVs, and it's a great business. We like Sun Communities, one of the big players in the space. It's a $17 billion market cap. This sector, because of the favorable fundamentals, Between 2011 and 2021, Sun Communities traded at a 24% premium to its net asset value. We love the fundamentals, but that's not what we do at Vision. We don't want to buy at a premium. We want to buy at a discount. And the last couple of years, we've been able to buy an accumulated position in Sun well below net asset value. This is a sector that's never had, ever, 12 months of declining net operating income. Credit, who's not going to pay their $200-300 a month land rent at a risk of losing their single biggest asset, their home? So we sleep well at night in this sector. And in terms of the apartment side, residential, we continue to really like Boardwalk REIT. This was, I think, the best performing REIT in North America, certainly Canada last year. We think we really like it. It's positioned in Western Canada primarily. And unlike other REITs in Canada, 72% of their net operating income is in non-rent controlled markets, primarily Alberta. Everybody understands the population growth and employment growth in Texas. As you understand, Alberta just went through the biggest period of population migration in their history. And it wasn't just immigration. I don't know about in BC, but if you were driving around Toronto in the fall of 2022, every fourth commercial on the radio was the province of Alberta say, Torontonians, you're looking for quality of life, affordable housing, move to Calgary. And it worked. The migration from BC and Ontario has been prolific. And if you look at recent transactions for apartment in June, a Calgary apartment sold for about $312,000 per suite. You look at Boardwalk's units today, they're trading at about $230,000 per suite. So a significant discount to the underlying value of what apartments are trading at in their backyard.
And the last on my list here, and this has got to be real estate jargon, but grocery anchored shopping centers. I mean, I remember being down in Palm Springs in the spring of 2009 when the stock market was the Dow Jones trade. It's not the Dow, but the S&P traded to 666 in the spring of 09. There were a whole shopping centers shut down. You know, maybe it was at Albertsons or something else was the grocery store that was there. And it seemed, I thought, look at, this is how they do things in the United States. When things go bad, just everybody, files for bankruptcy and then they move on. But sorry for the anecdote there, but it just stayed in my mind how dramatic things had changed from one year to the next. In Canada and in the United States, you like these shopping centers where they've got a big grocery store as the anchor?
Yeah, this is very defensive, necessity-based retail. It's anchored by the grocery store, pharmacy, and necessity. So you can't get your hair cut online. You can't get your teeth cleaned online. And so these are the kinds of tenants. They have banks, they have Loblaw, they have Safeway. We like it in both Canada and the United States. The largest holding in the fund today are the units of First Capital REIT. This has been a very active name. There's some activism in 2022. There's been some governance changes there. We profiled this last fall at a major investment conference as the highest quality grocery anchored portfolio in the world. That's a big statement, even for Vision. And we still like it. It's cheap to the net asset value. It's got a nice 4.6% yield. And whereas they have 22 million square feet of in-place grocery anchored shopping centers, they have 24 million square feet of incremental density to build apartments on those locations. Not greenfield sites in the middle of nowhere, but the best locations in the heart of Toronto, Montreal, Vancouver, Calgary, Edmonton, Ottawa. And we think this has a long way to go. And it's very high quality, very defensive real estate.
And that was First Capital REIT, did you say?
First Capital, FCR.UN on the Toronto Stock Exchange.
Okay. Jeff, here, just a couple of thoughts before you go. Right now, in your long-short book, what's the sizing of your short side positioning relative to what it might have been over the last 10 years or so?
So I think the best way to explain that is net exposure, which is the long positions minus the short positions. So you got $100 to invest. And if you put, 90 long and 50 short. Your net exposure is 90 minus 50 is 40. We've doubled our net exposure since the end of the year. And depending on our class of units, it's ranging between 55 to 75%, because it would be difficult for me to sit here and tell you that we think the timing is good and not to have increased our net exposure in the manner that we have had. So yeah, we've increased our net exposure to and one of the risk factors is we never have, or risk mitigating factors, we never have full exposure to the market because we don't use leverage. We don't use borrowed money. We don't buy stocks on margin. So we never have full exposure on the long side, even when our net exposure is, well, because our net exposure is 75% or 60%, et cetera.
But before talking with you today, I went back and listened to your interview that you did with Mike Campbell back on April the 13th. Just because I like to be prepared, and I like to check my facts and things when I say something on Money Talks. But back then, when you talked to Mike, one of the things that seemed to be really on your mind was that you thought that we had seen the last of the increases in interest rates, and the next steps were going to be cutting interest rates, and that was going to be the wind at your back with the real estate investments that you'd be making. Is that a fair statement?
Yeah, I mean, we've had so many headwinds in our space the last 2 years. I mean, Vision does really well, but the REIT sector, I mean, that's why it's so interesting, is even though there's been a recovery in the last 7-8 weeks, the REIT index is still the worst performing sector in the S&P 500 since 2022. So it's really early here, and those headwinds from the fastest pace of rate increases in the shortest period of time are now going to be tailwinds for the sector. And so if you get supply and demand right, we think that there's some, the timing is interesting.
Jeff, you've just been a terrific guest, and I always love to listen to you. This time I get to talk to you directly. I'd have to tell our folks here, visioncap.ca. Jeff has just kind of scratched the surface here with us today. Now, there's a couple of things. Jeff is given you some names that he likes, and then, you can go out and buy those issues yourself, or you could consider letting Jeff and his team do it for you. I think if it was me and my money going in the real estate space, I would take the second step. Jeff, any final thoughts before we say goodbye and see you next time?
No, I thank you for the opportunity to chat. I mean, we can only promise our clients two things. For good or for bad, what we do is pretty unique. So far, so good. And if we have the privilege of investors investing with us, we're highly aligned. Every employee at Vision is investor in the funds. You take out my personal residence, the majority of my net worth's in the fund. I got to go home and see my wife every day. And so risk is important to everybody.
Hey, on the floor of the exchange, we would call that you eat your own cooking.
There you go.
Jeff Olin from Vision Capital, thanks very much for being with us, and we will talk to you next time.
Nice to talk to you. Thanks, Victor.